Haha, fooled you. No music this time. I'm Dennis Hudson at orangequant.com. And we're continuing with the Hurricane, the Coming Crash series. This is the fourth video in that series. And just to let you know, we're gonna in this video we're going to still be talking about some of the triggers and explaining one that's very complex. And I know I promised to get to the reasons why you would get 10-year bonds. I'll probably touch on that in this video if we have time. So, we're looking at what I believe are a number of triggers lying around to throw us, send us headlong into this second crash. And here I want to talk about some of the problems with what the Federal Reserve has been doing and why some of that is about to come to an end as far as it being successful in propping up these markets. Oh, and just to add to my credentials here, this is the ebook I wrote back in May, June of 2007, and you can get a free download at whattolearn.com, crash.htm, or it's actually laid out on the page. And it basically forecasted everything we've been through. So those are some of my chops. Now some of this stuff, the economic stuff, is typically boring, and I find it boring too. So just so that you don't get too bored, I want you to have some oranges. You nibble on those, and we'll get through this quickly. But we all need to understand this stuff that I'm going to talk about is not my favorite subject to deal with, but we're going to have to deal with it anyway. So stay with me, because it aids in understanding when we get to the charts and so on later, the quant and technicals. You'll kind of have a justification in your mind for what's about to happen. All right. Here is a nice multicolored chart that that illustrates, and statisticians are going to, please don't write me about how terrible this is from a technical perspective. What I'm trying to illustrate here is the order of the kingdom, and normally things are orderly in a good economy. There's a relationship between inflation and stocks and cost of living and gold and the Fed funds rate. And so I'm trying to show that this is, a typical relationship. It doesn't mean one is higher or lower than the other. It's just stability. Okay, and this is what we were enjoying for a number of years, and then something happened. What happened was stocks came crashing down, okay? And we know the reasons behind that. It had to do with the housing market and so on. And gold started rushing up because what happened, people were panicking and they were nervous, and so they started buying gold, and that pushed the price of gold north. Now, of course, nobody intervened while you were losing money and your 401k was going straight to the devil. But after they got all your money, then they decided, oh gee, we need to prop up the stock market. Oh my goodness, let's prop it back up. Why? Because the banks were hurting. The mortgage companies were hurting. The lending institutions of our fine nation were hurting, and those rich fat cats on Wall Street needed a bailout. So what happened next? Here's what happened. The Fed cut interest rates to virtually zero, right there, okay? They cut the Fed funds rate, and that had an effect on everything else, so that stocks did a complete U-turn, and they went north like that, and gold actually made a right turn and went sideways right in there, and the cost of living, however, was also affected. Inflation was also affected. Now, this isn't necessarily in your official statistics, but you don't have to be a rocket scientist to know that the cost of living has been going up and that inflation is rising. You know this by going to the supermarket and the gas pump. And any number of economic liars can stand around and tell you, no, we're not in inflation trouble, the cost of living's not going up. But you know better when you go to buy that pound of rice that you used to get at 49 cents and is now costing you 89 cents. That pound of pinto beans that used to be 39 a pound is now 99 a pound. You know you got inflation. Same thing with tomatoes, ditto sugar, and everything else you need to have a healthy lifestyle. And it might surprise some folks to know that the Fed also is aware of this demon right here, demon inflation that I'm circling, and the demon cost of living. And the Fed is deeply worried about it. And I'll tell you, and you already know why, but for those who might not know why the Fed worries about such things, it's because when you have inflation kicking up, it tends to drive up the price of gold all over again. And they don't want gold going up anymore, because what that says about the US dollar is that it's weak. You understand? So the Fed is deadly afraid of inflation. You see, inflation not only makes the government look bad, but it also makes it harder to sell our debt. And the Fed absolutely wants us to be able to sell our debt, because the Fed needs to keep printing money so that the government can continue with whatever activity the government's involved in. And I'm not criticizing those activities. You know, that's up to the government. I'm not into politics here, okay? I'm just pointing out how this works. So the Fed's afraid of that because those who buy U.S. government debt are looking at inflation, and they know that with inflation, they're going to get screwed when they get paid back, because they're going to be paid back in cheaper and cheaper dollars. You understand? Okay. So the Fed is deadly afraid of inflation. Even though it wants to prop up its buddies on Wall Street. After all, the Fed is composed of bankers. Is run by bankers, folks. But you don't want to kill the goose that's laying the golden eggs. So you got to control the inflation. Now the problem, you see, is if in order for them to control inflation, they've got to raise the Fed funds rate back up. And that means it's got to go this way, because that's how they're going to control inflation, in part. They can't take it any lower to prop up stocks at this point. They're out of bullets on that because they've got the funds rate at virtually zero. It's 25 basis points. Might as well be zero, okay? So they're caught between the devil and the deep blue sea. They want to help their buddies on Wall Street, but they got to deal with demon inflation, and that's where they're going to go next. Oh, and there's another little problem here that we touched on earlier, but did I mention real estate? Oh, that's ugly. Oh, that's ugly. Let's make that color. There you go. Real estate crashing, crashing, crashing. And this is having an impact on those other factors that you're looking at. So the Fed is in a bit of a pickle here as to what to do. You see, if they raise the Fed funds rate, then they impact the real estate market in an adverse way, because interest rates will go up. And already people aren't buying the property anyway because they know it stinks, and because they're uncertain about the economy and they don't want to get into more debt that they can't afford to pay back. And on top of which, the banks aren't lending out the money that they gobbled up from the government in the first place. So the Fed's in a bind. But ultimately, all the Fed can do is raise that Fed funds rate, and that is going to send stocks down, okay? And I do mean down, and that's the crash that we're talking about. All right, switch reels. Go to video 5, please.